So let's take a look at the NASDAQ futures contract. This is a 1 month chart. Now obviously, we want to do a top-down approach when we're doing our analysis. The Tgif trade is going to be extremely precise if you are anchoring it against some higher time frame premium array or discount array. Now, I'm describing a premium distribution, meaning that the assumption is the market has been going up, and we're going to be looking for some measure of exhaustion for the weekly range, and then it will pull back into said weekly range. As you can see here, the monthly chart for NASDAQ, and so you can see here on a monthly chart, right here, we can see a small little imbalance in the form of a fair value gap, sell side imbalance, buy side inefficiency. That's defined by these ranges extremes, which is this month low, this month high, this only portion on the downside or sell side delivery. It would be requiring buy side delivery. So you can see buy side being offered here in the month of June 2023. So this is a premium fair value gap on a monthly chart. So with these levels in mind, let's drop down. Okay, you can see how on the weekly chart now you can see the weekly and those respective levels here from the monthly chart. You can see we did in fact reach up into a monthly premium fair value gap. The high of that fair value gap is here, and the low of the fair value gap is there. Okay, and it's linked directly on the monthly chart, but then dropping down to a weekly chart, it's going to look like this. So it doesn't look like there's a fair value gap at all on the weekly, but it is on the monthly. So we have to do our top-down analysis, and the hierarchy of my premium and discount arrays will work from higher time frame down to lower time frame. So you can see it is Monday, so the last week of trading. This is represented by that week here. So we've started a brand new week. So we're going to ask all of you in the audience to disregard this little candle. Just ignore it while it's being shown in the charts, because I have no way of taking that out. Okay, so you can see we did reach up into a premium fair value gap. Now, when it does that, it's very likely to see some measure of pullback. And you can see as we hit up in the upper end of this premium fair value gap on the monthly chart, but now we're showing it on the weekly, we went up to it and then came back down towards the low end of that range. Okay, and that range being, again, that fair value gap on the monthly chart. So let's take a closer look here and drop down into that little section of price action and take a closer look. Again, you can see zoomed in on the weekly chart. Doesn't appear like there's a fair value gap. The market trades just shy of that low, which would be, again, the monthly premium fair value gap high, or the highest part that makes a fair value gap. That was referencing the monthly time frame. There's a small, tiny little imbalance in here. I'm going to reserve commentary on that. So just focus on this area right in here. Okay. And notice how we've had multiple weeks of NASDAQ going higher. I've been counseling you to anticipate NASDAQ being the upside leader across the three averages, Dow, S&P, and NASDAQ. NASDAQ being the leader issue on the upside. And it has performed stunning fashion to the upside, outperforming the ES and outperforming the Dow. But I want you to take a look at how each one of these weekly candles are created. True, they're all up close candles, but notice where the close is. It's above midpoint of the candle's entire range. The close is near each candle's high. This candle here closed near the high. It closed really close to the high, close to the high, close to the high, and close to the high. So Power 3 is not linked to any one particular time frame, but when I first introduced it, it was appropriate at the time to teach it on a daily chart. Okay, so let's look at this with the reference of a weekly range. The low of the week, where we started trading here to open. In other words, this is an open, high, low, close bar. But from a Power 3 stance, the open, the decline below the opening price, the rally higher, making the high of the day, and then the close near the high of the day. This is Power 3, where we anticipate the market moving higher on the basis of a weekly analysis, higher time frame analysis. We think that it's drawing to a premium array, something to make it want to go up here or draw to it. And so on Sunday when the market's open, we anticipate, if we're bullish, that opening price or this opening price at midnight New York local time. It can open, drop down. We would not see that as bearish. We would anticipate that. So it's the accumulation phase below the opening price. The manipulation is the open and then decline, but we're utilizing that function to accumulate long positions. Or, for the purpose of studying, we would anticipate it opening, trading down into some discount array. What would that be? A fair value gap, running short-term sell stops on a lower time frame, trading down to an old high, something that would promote some discount or quote-unquote a support level. Then the market would displace higher above the opening price, return it into some kind of imbalance that would be seen with a bullish fair value gap or a bullish breaker, and rally up. So this is the expansion portion of Power 3, then creating the extreme high of the week, and then trading off that high to close. And this would be the distribution phase of Power 3. So it's open, high, low, close, accumulation of longs at that opening price and down when it drops below it. This is manipulation. This is where retail traders would chase that move lower, and then they get raked across the coals as the market goes higher, reaching towards some higher time frame premium array, some kind of target. Okay, think of it like I've outlined here. The market has been drawing each week up into this area here. Well, that's each one of these open, high, low, and close would be represented by each individual candlestick here. So even though these are candlesticks, this candle here would be represented by the open, then it traded down, then it rallied up, made the high, and then came off the high and closed near the high. Same function, but I'm teaching Power 3 with this open, high, low, close bar. And obviously everything I do is reversible, just whatever I've said in previous. For when it's bullish, you would just use it when it's bearish. You would open the accumulation of short positions when you think the weekly candlestick is going to go lower, reaching for some kind of discount array, some kind of sell side liquidity, something to that effect. You would see the opening price and then rally up. We would see this open as accumulation of shorts and then manipulation higher, tricking retail traders into thinking it's going to break out to the upside. Smart money would accumulate short positions here and then ride it down throughout the week, reaching to some discount array, and then before the end of the week it comes off the low, closes on Friday's close, near but off the low. So I want you to understand that premise. Now this theory of mine is not limited to a weekly, it's not limited to a daily chart, it's on every time frame. Every single time frame. So as long as you know where the next draw on liquidity is, regardless of what time frame you're trading, what style of trading you're utilizing, this idea of understanding accumulation, manipulation, and distribution will serve you well in terms of finding setups, sticking to institutional order flow. In other words, trusting that price is going to continue moving in your direction if you're on side. If you're off side, it means you're incorrect about what you think is going to happen in the marketplace. Then you're obviously going to get stopped out, and that goes without saying. So I want to take your focus into that very range right there that is encapsulated by a down and up arrow. So this weekly range here, okay? We're going to look at that. We're going to zoom in. With this range in mind, I want you to think about how, without those levels I have drawn on the monthly, you can see how if you don't have those reference points, it's kind of hard to determine what it would be reaching for. That's why you want to spend the majority of your time on a higher time frame charts, because the market's going to gravitate towards these higher time frame premium arrays or discount arrays. And if it's drawing towards a premium array, that means that the bias is going to be primarily bullish. Each day of that week or the week to come, you would be anticipating any decline is to accumulate long positions and then distribute those long positions to a premium array. So that week right there, let's zoom in. All right, and I'm using the continuous contract here so that way you can see the distinctions or the similarities. Right now it is mid-June 2023, and this is the NASDAQ weekly candlestick. So the low of the range is marked here. It is not the opening price. So the low of this candle is not the open. The open is just slightly above the low. You can see that small little separation there. And then we have the run higher, makes the high of the week, and then we close here on the week. The lowest low of the week, all the way up to the highest high of the week, that's your weekly range. Okay? So the range for that entire range of the weekly low and the high, when we assume that there is a high formed for the week, okay, and we can assume that is the case when we get to about 1:30 or so on the Friday, and then we can anticipate some measure of retracement into the weekly range if, now again, this is a major point that needs to be required in the analysis, if the market has reached some premium array. If it has not reached a higher time frame premium array, then it could continue into the close and close right on the high. So that's how you distinguish whether or not it's going to form or it's going to keep on going and close right on the high. But because we traded up into that monthly fair value gap, and because we have been trading up for a long series of weeks, each week being bullish, we've maintained a bullish delivery, and we have been maintaining a bullish analysis on stock index futures over the last few weeks. So none of this has taken us by surprise. But I want you to think about when you anticipate a high of the week is probably in, and I'll talk about that when we get into lower time frames. For the sake of conversation, let's assume for a moment that you had the ability to determine that there was a high already formed, and now anything going into the close on Friday of this week inside this weekly range, okay, try to ignore this one here. So I had to take the screenshot of this chart, and it obviously shows the new week we're working off of now. So this range here, we're not even concerned with this. We're only looking at the high of this candle and the low of that candle and the respective levels that's being identified here. So the high of the week range and the low of the weekly range, if you measure with a Fibonacci from the lowest low all the way up to the high, now you would be doing this intraday as you approach the afternoon session. It doesn't mean that you can't see this TGIF pattern form in the morning session. It's more likely to form in the afternoon, especially if we had continuation on the upside in the morning session, then it's more likely to create it in the afternoon session. But the range high and the range low, if you put a 0.20 and a 0.3 level on your Fibonacci, that's basically giving you the 20% and 30% demarker for the entire weekly range. And that's the only thing that's being shown here. I'm denoting where 20% of the range from the high down to the low, 20% of that range is here, which will be 15,326.75. And then 30% of that range would be 15,252.5. So those two levels here, that is your sweet spot. Okay, that's where TGIF will likely draw into. There are times when it can draw into 40% or more, meaning that if we can watch price delivery on Friday, whether it be in the morning session or the afternoon session, if we get to some level of a premium target being reached, or as we saw on the monthly chart, we traded up into that fair value gap. The day of the week is Friday. It's been going up every day. So it's within the realm of reasonable to anticipate the market drawing back. So if there was a reasonable means of measuring or a macro, a short little list of directives that the algorithm would follow to reprice from the highest high of the week down to some predetermined price, what would that be? Well, we're going to walk through that here. But the bullseye, if you will, the little sweet spot that the market can retrace down into, in other words, we don't anticipate it closing right on the high, so if it's going to come off the high before Friday's close and ending the week of trading, it's going to stop somewhere between the 20% and 30% range. So here is that same idea now being applied to and on TradingView, if you're following along on that, that's the teaching medium I use, and pull it up on a weekly chart, you would see that this range, again, disregard this. This is the new week candlestick, so we're not worrying about that. We're talking about last week and how we could have used this information on Friday. So here's 20 and 30% of that weekly range from the high, and those levels being shown here: 15,326 and 3/4 and 15,252 and a half. All right, here's the NASDAQ September contract daily chart. All right, we can see that this candlestick here makes the high of the week, and the high comes in at 15,475 and a half. And then we trade down into the range between 20 and 30% of the entire weekly range, the weekly range being the high here and the low here. 20% of this entire range here subtracted from this high would give us this level right there. And then 20 and 30% respectively would be that TGIF draw on liquidity. Okay, so think of it like that. The market will likely draw down to 20 or 30% of the weekly range. So that's how we can anticipate Friday's trading in terms of a intraday reversal or a weekly retracement. I'll leave it up to you how you want to classify it. Okay, either one of them would be considered correct in terms of describing what it is you're trading. Monday's trading here, Tuesday's trading, Wednesday, Thursday, and then Friday opening, making the high of the week, and then trading down and closing inside that 20 and 30% of the total weekly range. That is a successful TGIF trade. Right here is an hourly chart. Okay, you can see how, again, we had a short-term high, we rallied up. Don't look at this as support because we don't know what the high is yet. So I'm just showing you these are the levels that once the high is in place, and we can anticipate forming in the lunch hour or just before lunch, around 1:30 going into 2 o'clock, the assumption is that we're likely to draw down into 20 or 30% of the weekly range. If we've been bullish, and we've been bullish for a while, and we hit our higher time frame premium arrays and targets, so it's reasonable for it to draw back. If it's going to draw back, it's going to do so in a controlled manner because the market is algorithmically delivered. So price is controlled. It's following a script, so therefore where can we anticipate the market to draw down to if a retracement is in fact what's going to come in before Friday's close? We have to define where the weekly high is. The low is obviously here, it formed on Sunday. So Sunday at 6 p.m. we're seeing that candlestick here represent that weekly range low. And then we can see Friday, all that range in here, the highest high, we anticipate that high forming Friday morning to Friday lunch, or certainly between 1:30 and 2 o'clock. Why? Because it's likely to retrace into the close. So that's our weekly range viewed over the scope of an hourly chart. Okay, so we're going to get into this and get a little more detailed. Dropping down inside that range and zooming in towards the high end of it, this is the 15-minute candlestick chart. So 15 minutes, we can see that the high forms in here around the 9 o'clock in the morning hour on Friday. It rallies up, creating what? So if we can see that initial surge at the open on Friday, as we see here, the market runs up, creates this tendency to want to expect it to keep going higher. An old high is broken here, but I teach that that is buy-side liquidity. So the market goes higher to run out these relative equal highs because those pending orders that would be used for traders that trade on a breakout, they want to buy strength. Smart money employs that as their counterparty to going short. And they're going to trade with this in mind, 20 to 30% of the weekly range. The up close candle is what we're measuring, whether you want to have the wherewithal to go short up in here or not. You don't need to. You want to wait for it to displace one big candle up and then It runs right over top of it. That opening price is where the change in the state of delivery is made when it goes back through it, which is right here. Then we have a short-term low taken with this candle, and it closes and creates another candle here. And then as soon as this candle starts trading, we have what? Does that sound complicated? Because it's not. It's really easy. But how do you trade it? How do you go in and implement it? Take it and go out there and study it. You go through the process of everything I've already taught you. You could trade the turtle soup, which is the run here above the buy side. So when the buy side's taken, you can sell short right there. That's a very, very difficult thing to do for new traders. You have to really trust you know what you're doing. You don't need to be able to do that. Wait for it to give you your 2022 model. Here's your fair value gap with the short-term shift in market structure here, or if you want to use that one, either one, it validates it. Then it trades up into what? The 2022 entry model. So it's trading in this little area, and because we have to traverse over lunch, that's why we have multiple passes during the lunch hour. Nothing has changed. Treat this candle and this candle, and the highest one that trades into it, which is this one here, until we take out the low here, and as long as we don't take out this high, all of these candles in between are all time distortion. The range is already defined. Okay, so obviously you see how we moved from this area here, this fair value gap in the form of a SIBI, sell side imbalance, buy side inefficiency. So this move down here, separated by this candle's low and this candle's high, all the sell side needs to be what? It needs to be delivered with buy side. We see that here. But look how many times it's doing it. Why is it doing it that many times? Because it has to traverse through the lunch hour. The lunch hour, there's a macro that runs within lunch hour, and it usually runs what? The stops. So where would the stops be? Right above this high. We see it run there, and we return back to it here, but there's no necessity to get above it. It's just respecting with these little mohawks, these little tiny little deviations outside of the range that creates my fair value gap. This low. So it goes above it here a little bit and a little bit here. We expect that. We anticipate that type of thing. It does not undermine the overall scenario. Then you watch price melt into the 20 to 30% of the range before Friday's close. And that would be the shaded area here. Zooming in here, again, you can see this is the 15-minute order block. And we're trading up into that shaded area that was found and defined on the hourly chart. You can see we have that run on the stops here. Then we drop down, take out sell side, and then one more time rallies back up to the 15-minute bearish order block. So this is a reclaimed bearish order block. Sell side's below here. The market drops. Here's the model 2022 again. Short-term low. Drop. Fair value gap. Rally up. If you don't get that entry, okay, because it's before 2 o'clock and you have a rigid rule set now that you're going to be algorithmic behind every trading idea that you employ, whether it be paper trading, studying, or live trading, you're going to stay within these sweet spots in terms of time. I've already taught between 2 o'clock and 4 o'clock, the afternoon and PM session. You can find a trade, or price run that will seek liquidity. It's Friday. The market has shown a willingness to do what? Give a Judas swing in the morning. We're seeing that here. This is a Judas swing. Then it overlaps all that. There's a change in the state of delivery here. That's your bearish order block. We have a Model 22, 1 hour fair value gap in the form of a SIBI. That's this shaded box here. And then we hit the bearish 15-minute order block again. It drops, creates a fair value gap. It's also a breaker. High, low, higher high. How many models have I shown you already? Which one would you have taken? Don't look at, okay, well, if I sold up here, that would be more money than entering on the fair value gap here or trading into the breaker here. You may not have recognized this as a fair value gap, but you can see this high, low, higher high, the down close candle here. Extend it through, and it's trading onto it here and here. Here is a 1-minute chart zoomed in. Here's that fair value gap inside of the hourly fair value gap SIBI, and where it bumped the bottom of it and then reacted during the 2 o'clock hour, created the fair value gap with the breaker, high, low, higher high, reaction. We're seeing this is a signature saying that yes, order flow is bearish. Yes, the algorithm is driving price down towards the 20, 25, and 30% of the weekly range. That's where we'd anticipate it. It gives you a fair value gap. I'm getting short here, 15 contracts at 15,357 even. I want to be ahead of that candle's high. I want to make sure I'm getting filled. That was my entry. I'm holding to see if we get into the last hour of trading, how we trade. We trade into 3 o'clock. We trade half of the 30 and 20, so 25% of the weekly range has been traded to here. Small little retracement, and then I'm anticipating another drive lower. I'm not trying to buy it. I want to see, does it take out that low that's formed in the last hour of trading. Here is sell side. My limit order was placed right there. As it went down into it, boom.